Chapter 3, how securities are traded, and we're just going to talk about how markets work. Again, this is not an exhaustive list. We're not going to talk about everything associated with all markets. We'll just try to hit some of the most important spots. Okay, so here's the chapter outline. First is how do firms issue securities, and then we're going to talk about this IPO underpricing, which is sort of an interesting phenomenon. We'll talk about trading mechanisms and market types. We'll talk about direct and indirect trading costs, and then we'll move on to the limit order book and types of orders that are commonly placed. We'll talk about some new trading strategies, and then we'll spend a bunch of time talking about levered long and levered short positions, i.e. buying stocks on margin and selling stocks short, also using margin. Okay, first, how do firms issue securities? Well, they do so through investment banks. An IPO, which is an initial public offering, or an SEO, which is a seasoned equity offering, sometimes a secondary equity offering, and this is when a company offers stocks when they have already issued stocks, or they do it through private placement, where they put it through, they put the stocks to large purchasers of securities, large portfolio managers, like managers of insurance portfolios, or pension portfolios, or endowment portfolios. And so they can place them privately without offering them to the public. Obviously, private placed securities have significantly lower cost than public securities, which can then be traded on markets, and we're going to spend a bunch of time talking about that. Firms will offer the securities either on a best effort versus a firm commitment. A best effort is when the security is sold by the investment bank for as high a price as possible, and the investment bank takes a percentage. A firm commitment is when the investment bank sets a fixed price that they will pay to the issuer, and they keep anything extra. And an underwriting syndicate is when you have a large group of investment banks that all get together and try to sell the security together. That's a syndicate. It is often the case that an issue is large enough that a single investment bank doesn't have enough customers to issue all the securities, and so they put together a syndicate. And historically, they would put an ad in a newspaper, the Wall Street Journal, when there'd be a print ad in the Wall Street Journal announcing the issuance of a security, and it would list all of the different underwriters, and all of the largest underwriters would have their logos printed the largest, and so they were referred to as the bulge bracket underwriters. And so this term bulge bracket still refers to the largest investment banking companies. Most initial public offerings are underpriced, at least by a little. Why? Well, they underprice them to ensure that they all sell. If I sell the stocks for $20 and some people think it's worth 19 and some people think it's worth 21, then they may not all sell. And so if I underprice it by just a little bit, then there's a much higher probability that the entire issue will sell or the offer will be fully subscribed. Fully subscribed means that all the shares are purchased. And if the offer is not fully subscribed and it fails, it's a signal that the company was priced too high. When it's offered again, it's usually at a much lower price. And so the goal is to avoid the really awful negative signal of having an offer fail and not be fully subscribed, and so the stock is underpriced. And how do we know it's underpriced? Well, the offering price will be 20, and then within a few minutes or by the end of the day, the price will be higher. Now, if it's a few dollars higher versus twice as high or 3 times as high, that's a big difference, and we'll do an underpricing example. We'll do that during the lecture.